This is your LMAX exchange technical update for Wednesday, July 12, 2017. Euro dollar. So the euro continues to extend its 2017 run, with the market trading up to another high on Tuesday and inching closer to that critical barrier at 115. As you can see here from the weekly chart, the market is coming into this major resistance zone between 115 and 117 going back to 2015, and this represents a range resistance off of what has been a consolidation since 2015. If we consider a recent move in euro dollar, with the market putting in a high that had been in place around 114.45 and then a minor pullback to the 13.10 area, that's 135 points before breaking out again to fresh 2017 highs. So if we add 135 points to the recent high that was in place at 114.45, that takes us up to about the 115.70 area. And so we shouldn't rule out the possibility now for a move into this resistance zone towards 116 and into that 115.70 area before the market considers the possibility of stalling out. At the same time, overall on this longer term chart, there is risk given this run that we've seen in 2017 for the market to stall out. And so if we get up above 115 and towards 116 and we get up into that 115.70 measured move objective, there could be a sharp reversal that ensues over the coming weeks as the market adheres to this range and rolls back over. Ultimately, right now, key support does come in by that 113.10 area low that we saw in around early July, and a breakback below that level would be required at a minimum to take the immediate pressure off the top side. Sterling dollar. So cable has been content to consolidate over the past several sessions, with the market once again stalling out above 130 as it stalled ahead of that 2017 high that was in place from back in May at 130.48. At this point, the outlook overall is quite constructive for this market on a medium to longer term basis, following the breakout above a critical range high that was in place at 127.75 from earlier this year. But at the same time, there's risk that we see more consolidation before the market ultimately pushes higher towards what is now the next key measured move extension up at 135. Any setbacks that we do see over the coming sessions should ideally be very well supported ahead of 125, with only a breakback below 123.60 to compromise this constructive outlook. But again, more choppy trade could be expected before the market looks to push higher, and so the strategy for sterling dollar should be looking to buy this market into extended declines down towards or close to the 125 handle. Dollar yen. So dollar yen is traded up above 114, with the market coming up and testing some key resistance that was in place around the 114.40 area. As we've talked about in recent updates, this is a market that, despite this latest up move, is still chopping around more than seeing any bullish developments. And at this point, while the market holds around this area, there's risk for another topside failure and some more range trade ahead of the next extension to the downside, which could take us all the way back down towards a retest of that 2017 low that was seen back in April, just shy of 108. It would really take this market to establish above 115, 115.50 to suggest that we're seeing a breakout and a more significant continuation of gains and bullish resumption in the dollar yen market. Euro Swiss. So Euro Swiss continues to push higher after breaking above a key barrier at 110, and this suggests that we could see an acceleration in this market up towards the next key resistance point, which is that 2016 peak at 112. That's a very important level, and so the risk is that we continue to see this move now following the break of 110 towards 112. Ultimately, though, the market is looking a little extended, and there is risk also for a topside failure. We would need to see a breakdown back below the 109.80 area to take the immediate pressure off the top side. Aussie dollar. So Aussie has been a market that's been chopping around over the past several months, and as the market comes up into the resistance towards 78, it continues to show signs of stalling out. We've seen this already earlier in 2017 when the market put in a 2017 high in March at 77.50, and most recently the run up that we saw in June taking us up all the way above 77, but stalling shy of that 2017 high at 77.50. And so rallies continue to be very well captured capped here, and the expectation is that the market could eventually roll over again for a move back to the downside, potentially exposing a drop all the way back down towards the 70 barrier in the weeks and months ahead. Dollar CAD. So dollar CAD has recently traded down to a fresh 2017 low, and technically the market is looking a little bit extended to the downside following what has been a 10 big figure move since the market put in a 2017 high back in May, just shy of 138. At this point, on a longer term basis, the structure is still actually constructive, and so this setback should be very well supported now ahead of a resumption of gains. We would, however, need to see the market establish back above 130.15, some resistance from the other week, to suggest that this down move has exhausted itself and the market is ready for a bullish resumption. Kiwi dollar. The New Zealand dollar continues to chop around over the past several months, and rallies in this market have been very well capped up towards the 74 and 75 handles. And so this latest topside failure that we're seeing here ahead of these range highs suggests that the market could be poised for another rolling over back down towards that critical support that we saw from earlier this year back in the month of April, at early May, around 68.20, which is the 2017 low. SPX 500. The S&P 500 has been showing signs of stalling out over the past several sessions, but overall this is a market that retains its highly constructive outlook, with the market trading just off a record high that was seen earlier, just above 24.50 in June. A break above that level would open the door for an extension towards 24.80, which is a measured move extension following a consolidation earlier this year of 80 points between 2400 and 2320. And so there still is risk for a move up towards 24.80 over the coming days, and while the market holds above 2400, that risk is well intact. If we see a breakdown below 2400, that would force a shift in the structure, or at least take the immediate pressure off the top side, while ultimately it would take a break below 2320, that low going back to March, that would require a more significant bearish structural shift. Gold. So gold has seen a breakdown in recent trade, with the market taking out a previous higher low that had been in place at 1214 to suggest that we could see this market compromising what has been a more constructive outlook over the past several months. At the same time, the market has been supported ahead of 1200, and if we see a push back above 1230 over the coming sessions, it could keep the more constructive outlook intact despite that break below 1214, and put the pressure back on the top side for a retest of the 2017 peak just shy of 1300, above which will expose a move up towards the 2016 high at 1375.